Welcome to another Taking Stock episode for the week ending the 10th of July 2026. I'm Kien, Trinh, Head of Research at Stock Doctor. And joining me today is our senior analyst, Jason Yin, to stream to you all things share market. Welcome, Jace. How are you today?
Very good. It's great to be back.
Great to have you on board. But before we begin, just a reminder that today's discussion is general in nature and doesn't consider your personal financial circumstances. Well, Jace, markets remain quite volatile this week as investors continue to assess renewed tensions in the Middle East. You've got higher oil prices once again, and that's raised concerns that inflation could remain elevated, potentially keeping interest rates higher for longer.
Yeah, that's right, Kien. It seems like Groundhog Day almost every single week. The macro backdrop obviously remains quite uncertain, and it's been another pretty busy week in terms of company updates. We've had several stocks experiencing significant share price moves following earnings updates and also corporate developments, which we'll touch on a little bit later on this episode.
Yeah, certainly confession season continues with homewares retailer Adairs. They were among the biggest disappointments after warning that they expect to report a statutory loss following a significant write-down of their focus on furniture business. Also, Telstra came under pressure after a nationwide outage disrupted mobile and data services, highlighting the operational and also reputational risks associated with such critical infrastructure.
Yeah, not going well for Telstra at this point in time. On the positive side, and also surprisingly, building materials and construction businesses, Fletcher Building upgraded their earnings guidance after a stronger than expected property sales and also improving demand across its manufacturing and distribution businesses, which has been rather positive. Meanwhile, logistics provider WiseTech has also been back into the news headlines after founder Richard White stepped down as chairman, reducing one of the key governance concerns that has weighed on investor sentiment over the past recent months.
Yeah, and I also noticed Jace Wealth Software Business and Stargrowth stock Bravura, they released an update as well with an earnings upgrade. So plenty to unpack this week, but let's start with
Mm.
some interesting star stock highlights. And the first we want to talk about is sleep apnea and respiratory care business, ResMed. Now, the company announced that it will sell one of its business, Matrix Care software business, for around 490 million, and that was below the 750 US million it paid for the asset in 2018. Certainly, this has raised some eyebrows.
Yeah, that's right. It certainly did, Ken. Look, the transaction partly reflects the fact that the company might be growing a little bit concerned about the impact of artificial intelligence and the ability of AI to reduce the longer term value of that certain software business. So management said that the decision is primarily in terms of simplifying the portfolio and also concentrating its attention towards higher growth, sleep health, and also connected home care businesses, which should be good. And the market voted in a bit of confidence in that as well.
Okay, and from an investment perspective, we don't think the announcement does materially change the long-term thesis here. However, investors should be cautious, especially around those competitive risks, including wider adoption of weight loss therapies and emerging oral treatments for sleep apnea. And those risks are worth watching, especially out into financial year 27, even though they have reaffirmed their guidance for financial year 26. But next up on the list is Jumbo Interactive, Jace, the online lottery operator. Now, despite providing guidance which was broadly in line with expectations, the shares responded positively. Why do you think that was the case?
Yeah, look, expectations coming into the start of this week was really low, and that was on the back of a large broker downgrade that we saw a week or so ago. The broker downgrade pointed to weaker jackpot activity and also some of the uncertainty around the reseller agreement with the Lottery Corporation, as well as some of the concerns around any regulatory changes within the UK prize draw market. So investors were a little bit relieved that nothing worse came out and management still, I guess, in a way, upgraded a little bit of their growth expectations. So all things pretty good, and the share price tracked quite positively on the back of that news.
No, great to hear, Jace. I mean, I've been seeing that there's been negative earnings revisions coming through, but
Yeah.
despite this, there were also some encouraging operational trends, as you alluded to. I mean, Dream US significantly exceeded expectations, offsetting softer performance in the Dream UK, where management is investing for future growth rather than responding to weaker demand.
Yeah, that's right. Look, the most important takeaway from this is that the company is diversifying away from the core Australian lottery business and onto other growth junctures as well, namely in the UK and in the US. Combined, the company also trades on a pretty attractive dividend yield of around 5%, which helps to support some of the valuation given the recent sell-off that we've seen. So we continue to support the company and like it from a growth perspective as well as an incomes perspective. And it should be a pretty good investment for patient investors.
For Under the Microscope this week, let's focus on Netwealth, one of Australia's leading wealth management platforms. And despite continuing to grow their funds under administration and also gaining some market share, the stock has underperformed over the past year. So, Jace, what's changed?
Well, there's been two main reasons, Kien. The first one is obviously the collapse of First Guardian, and this resulted in the company setting aside around $100 million in order to compensate some of the affected investors. This was a bit of a one-off issue, but it did increase regulatory scrutiny and also weighed on terms of investor sentiment. The second thing as well, investors were questioning whether AI could strengthen the competitive position of larger incumbents like AMP, which could potentially limit the company's future market growth opportunity. So the combination of these is what weighed on a lot of the expectations.
Yeah, that AI threat remains a big overhang, especially across all these growth stocks. But despite these concerns, I guess the underlying business continues to perform reasonably well. And while
Mm.
financial year 26 net inflows were slightly below expectations, and that was due to market volatility and uncertainty around proposed tax changes, management did upgrade their financial year 27 inflow guidance and also announced a strategic partnership with Morgan Stanley Wealth Management Australia.
Yeah, this is a pretty interesting update. The Morgan Stanley partnership validates effectively the company's investment in its private wealth platform and opens up another avenue for growth opportunities in the future. Management's also investing quite heavily into technology as well as distribution as well, which will temporarily reduce some of the margins, but should support stronger earnings growth over the longer term. Importantly, earnings revisions have remained rather resilient despite some of the headwinds that we pointed to earlier.
Yeah, great to see, Jace. But I noticed the stock still trades on around 40 times forward earnings,
Mm.
which does appear expensive at first glance. However, high quality platform businesses have historically commanded quite a premium multiple because they can compound earnings over many years. And if net wealth does continue delivering double-digit earnings growth, that PE could naturally become more reasonable over time. It's now time for question of the week. And with the new financial year underway, many investors are asking where can they find emerging investment opportunities?
That's right, Ken. And opportunities is the name of the game. And one of the easiest places to start is using Stock Doctor's preset filters. Members can simply select Tim's growth filters with potential and also Tim's income stocks with potential, and then sort companies by metrics such as earnings revisions or discounts to fair value.
Yeah, quite a few opportunities that come out here, but from a growth perspective, you've got a few companies that appear on these screens, including Duratec, which provides engineering services to the defense and infrastructure sectors. Also, Elsight, whose Halo technology that enables highly reliable drone connectivity as well.
Yeah, there's other companies within this list, and that includes Lycopodium, which is a mining and engineering consulting company that is benefiting from the strong resource investment that we've seen in the sector, and also Genus Plus, which is well positioned to benefit from Australia's growing investment in electricity transmission infrastructure to support that AI thematic.
Yeah, some interesting names there, Jace, but members can also build their own thematic filters as well. For example, investors looking to capitalize on that significant investment in AI and data centers might screen for businesses such as Southern Cross Electrical Engineering, while those expecting defense spending to remain quite elevated can identify companies with increasing exposure to that sector through the business description field as well. But that brings us to the end of this week's episode of Taking Stock. Thanks, Jace, for your insights. I know things are going to get really busy as we're heading to reporting season.
That's right, Kien. And for members out there, if you know someone who could benefit from Stock Doctor, we would really appreciate you sharing a referral link.
Yes, that's right. And finally, just remember that while markets continue reacting to geopolitical events and daily headlines, those are largely outside our control. Instead, focus on what you can control, owning quality businesses, maintaining diversification, and managing risks, especially as we head into the next reporting season. Until next time, have a happy, healthy, and prosperous week ahead.